What's good, y'all? Let's get straight into it. The conversation we'll be having today is about how to analyze a company in the stock market step by step. By the end of this, you will be a top tier investor. You'll actually know how to break down companies, what things to look for, and elevate your game, essentially. So what we'll be doing is kind of going through how I look at companies, how I break them down, the different things that I look at. And then I'm going to go through an example with you guys, just so you can kind of see how we do it. But essentially, let's get into it. All right, let's get into it. So the final verdict. So this is really just a big picture conclusion on the stock based on all the different signals, technicals, and fundamental things that I'm seeing. You know, what is our rating for the company that we're looking at? Is it a growth compounder, which is, it's a winner overall? This is something that you love to add on to through drawdowns, through tough times, whatever it may be. A company like Meta or Microsoft, or I guess Apple. That's a big company. So you could also do that. Then there is the long-term hold, which is steady, safe, not as explosive, but it's good for core positionings for your main portfolio, your stability, And then we also have our last classification, which is the options play only. So for the company, it's not really a buy or hold, but it is good for options trading if that is the route that you're going down, All right. So we kind of have 10 different pillars that we use to stack our base. And the first pillar that I always look at is the company snapshot. I feel like this is the best way to kind of size up a business, look at what it does, how big it is, and what phase it's in, right? So what I typically will do, and I always do my research on Barchart, Yahoo Finance, those are good ones. Those are good ones to start off with. There are a lot more advanced ones, but those are good ones to start off with and kind of familiarize yourself with. But sector-wise, this is essentially what part of the economy the company lives in. Is it technology? Is it residential? Is it utilities? Is it energy, finances, et cetera, et cetera? Then we look at the market cap, and that's essentially the total value of the company in the market. It shows its size and, its sentiment with regular people. Then the current price is, of course, the current price of the stock, Then I think one of the biggest ones in this section that I kind of look towards is the growth phase. Where is the company in its life cycle? Is it exploding? Is it mature? Is it stagnating? What phase of life is it in right now? That's kind of a good thing to look at to see where the company is going in the future and what you want to do with the company. And then we have the narrative, which is essentially the story investors believe about this stock right now. All right, let's move into the second pillar, which is liquidity and behavior metrics. So this is essentially how the stock moves on its own, like how it trades, its volatility, buybacks, who owns it, crowd psychology, all that good jazz. But in my opinion, the most important thing to look at in this pillar is the average yearly drawdown. This is a massive one, especially if you're looking to actually get into a position long term or you're looking to do options trading. The average yearly drawdown is quite literally just that. It's like on average, how much can you expect this company to pull back within this year? What does it look like on a 1-year scale, 5-year scale, whatever it may be, right? Then for the second part of this, you have the buyback announced. You're really just seeing if the company has confidence in itself. Like, is management buying more shares of the company? Are they confident in their vision and what they're doing? Next, we have the retail flow velocity. This is kind of how retail is trading the company. Are they looking at it, what they're seeing on a retail level? So more flow is equal to more crowd risk, which is equal to more opportunities, And with the smart money flow, this is a big one in my opinion, just because you're looking at what are big institutions doing? where are they parking their millions and billions of dollars in the market? I'd like to be on that side personally. So now on to the next pillar, which is the sentiment mesh. This is basically just kind of like looking at the market emotions on the company, retail versus institutional, and looking to see if there's any split or divergence. So the retail sentiment is basically our individuals looking at this company in a good light, a bad light, or let me stay away from this and not touch this with a 10-foot pole type of light, And then we have the institutional sentiment, which is clearly, are these big funds like heavily scaling into a company? Are they looking at it kind of cautious, or are they still scaling into it but also keeping capital on the side? And then the divergence is basically looking at, is there a difference between retail or institutional views on the company? And then we have the red flags. This is obviously something to bring up, just like if you're looking at a company, is anything weird going on? Valuation, debt, failing earnings back to back, reporting false numbers, all that type of stuff, right? It's important to look at. And then for our next pillar, we have the narrative arc forecast. This is honestly just my best estimation on what's going to happen next for 3 different time horizons. We have the short term, the medium term, and the long term. The short term is just 3 to 6 months. Like if you're doing options trading or kind of wanting to see how this company will move in the short term future, this is a good thing to look at, for tactical trade ideas and price drivers. Medium term, you could still be looking at this for options, but this is kind of where you start looking, okay, this company's been performing pretty good throughout this year. Is this something that will continue? Is this something that's not going to continue? Right? And then we have the long term, which is obviously for if you're wanting to invest in this company for the long term. This is kind of looking at how the company's been doing over the past 2 to 5 years and where it can continue to go, with whatever advancements we have going on at the moment. Now, let's get into our 5th pillar, which is the defensive edge, right? This is essentially the moat. This is essentially what protects the business from its competitors. What sets this company apart from its competitors? And I give you like a behavioral and a technical read on the company. So for the moat, this is literally what keeps competitors out. Is it the brand, the technology, the network regulation, the way that they're interacting with different farmers in the space? For example, Chipotle, whenever they set up shop somewhere, they get to know the local farmers and cut them a deal. Now, we talk about the ghost premium zone as well, which is really the magnetic price range where institutional money is likely to push the stock next, and then we have a regret probability. And this is how likely you are to regret not being in the stock after a big move. So for example, a lot of people are talking about how Robinhood was up at whatever it was up at and then dropped down to be like in the low 50s, low 30s, and now it's doing pretty good. It is doing pretty good for itself right now. So regret probability. And then with this, there is also a liquidity trap risk. So a liquidity trap risk is actually a lot simpler than it sounds. It's basically the risk of getting trapped into a bad position, right? So say that you're doing your options trading or you're wanting to do long-term trading and you see this company just running, you're just like, damn, I want to get into this company very bad. So you get into the company when you knew you shouldn't have gotten into the company and it's running, and then right after you get into the company, it drops. Your option call is up 10% and then drops, or you're long-term investing. You're like, oh, damn, I don't see this, slowing down anytime soon. And you get into it at its all-time high, then it drops, something like that. Then we have the behavioral confluence score. And this is basically just looking at how perfectly our technicals, our sentiment, and everything else that we're looking at for this company, how well is that lining up? 10 is a perfect score. right? So our next pillar is obviously the chart levels. You don't have to be a master at this, but it is essential to understand the key price points the company has hit and will hit. It's good to see the support zone just to see where buyers are actually showing up. And this is good for long-term entries, and this is also good for options entries. Then you have the resistance magnet, and this is typically where sellers are taking profits, or, this is where a breakout can happen because old resistance becomes new support, right? And then obviously we look at all-time highs. So this is clearly just the highest price that the stock has ever hit. And this is important to see because if a company hasn't had, an all-time high in the last 5 to 10 years, then it kind of shows a sign of the company's not moving how you would want it to. Not by any means like this has to be the measure, but it is typically good for a company to hit at least an all-time high once a year, Maybe once every 1 to 2 years it's a pretty good metric to see. Is this company still growing? Is it still, in that phase where it can push me up some money, right? Now let's get into the next pillar, which is the valuation pulse. And this is basically just talking about how expensive or cheap the stock is versus its actual growth and value. Now, I break this into the forward PE, and the forward PE is literally just the price divided by expected future earnings. And then we have the PEG ratio, which is the price earnings versus growth. And this shows if the price makes sense for its speed of growth. You don't want to pay too much of a premium for a company that's not actually good. You know what I'm saying? You want to get a good deal. And which is why I also look at the enterprise value. And this is the total worth of the company. And you do this by just taking the market cap plus debt minusing cash, just to see for a big picture valuation what the company's doing, how it stacks up. And then last but not least, this is my favorite part of this section, this pillar, because it's so crucial. You have the free cash flow versus debt. So you always want the free cash flow to exceed the debt, because think about it. Would you rather get into a company that has a lot of free cash just sitting on the side, or would you want to get into a company that has a lot of debt just sitting on the side? And it's not bad for companies to leverage debt, but what you want to see is more free cash flow than debt. You don't want to be broke. You don't want your company to be broke. You don't want to invest in a company that's $1 billion in debt, but their free cash flow is maybe $1 million. It just doesn't add up. So now for the 8th pillar, we have the seasonal return matrix. And this is a huge one. A lot of people don't look at this for whatever reason. I just genuinely don't understand. But hey, you do you. You do you. Well, you guys aren't going to do you. You're going to listen to this because you have the information. You see it in front of you and you know how you're going to perform. So the seasonal return matrix is literally just how the stock tends to perform in different months of the year. Once you once you see the pattern of how a company moves, it's so easy to make money off of that company because you can see exactly when the perfect time is to get into the company, and you can see the exact perfect time to exit your options plays when the company's, really up. And I kind of look at the 3 main things, which are the highest average return month. So this is obviously the best month for you to exit your positions and take profits. Then you have the second highest, which is, maybe you weren't able to hit that first averaging return month. You weren't in that window, but you can also exit on the second highest because you want to exit into strength if you're closing out a position or you're wanting to take profits on anything. Then the lowest average return month is the best time for you to actually get into a position, whether that be long-term or whether that be for options trading, because you're getting everything at a discount and you want a discount. Who wants to pay full price for a beautiful company? It's just good to get it at a discount and then get the appreciation on top of that. So for the ninth pillar, this is also pretty big too. It's kind of looking at the top competitors. So it's kind of seeing who's the biggest, most dangerous rival by sector, by market cap, by returns against this company. So how does it truly stack up in its space? Is this a strong company, or can it get eaten up easily by its other companies or its competition? This is a good metric to look at as well. And then speaking of metrics, look at that. We are at our last pillar, which is the summary metrics table. And this is basically just a rundown of the revenue growth, profit margins, return on equity, all that good jazz. These are your hard facts that you're wanting to look at. Is this company profitable? Are they going to bring me money? And are people, in good faith with the company? Okay. And now that was our first little section of it. If you guys have any companies you do want broken down, or, just are interested in seeing, we could definitely do that for sure. But let's get into the Uber example. So Uber has been doing some absolutely crazy stuff just because of all the technological advances we have. Robo-taxis have become a very big part of our life, and Uber is definitely taking a lot of commissions off of it, essentially. So they are the biggest reason that Uber was not profitable in the beginning was because all of their profits were going to the drivers, right? Now, if we have automated systems for these automated cars, driving by themselves, doing Uber Eats and all that type of stuff by themselves, you're taking out the biggest capital expense. So that's why Uber is going to be such an important company in the future. Well, not even in the future, right now, literally right now in real time in 3D. So that's why I gave this company a rating of growth compounder, right? Now let's actually get into the company and break it down. So going through the pillars again, this is the first pillar of the company snapshot, right? So the sector that it's in is technology and services. It's kind of at an intersection between tech and all that. Its market cap is $175.2 billion with a B. This is a pretty big number, but let's look at its current price. As of 7/25/2025, its current price is $91.29, pending to change, And it's pretty close to its 52-week high, actually. It's been running like crazy. It's insane. But the growth phase that it's in right now is cash flow expansion. So since it's transitioning to profitability, the profit margins are starting to scale, and a lot of institutional investors who have already been parked into this company are starting to double down, which is why it got pushed up to its all-time high. So with that, the narrative is clearly evolving because a lot of people weren't looking at Uber as, a big company on the market. So it's come from disruptor to a dominant platform, and they have a very big brand. We'll go over that in the moat. So pillar 2 is the liquidity and behavior metrics. So its average yearly drawdown is sitting around 20%. It has some high volatility, but it recovers pretty fast. It's not like a dangerous company to be in. Now, recently there was a buyback announced at 1.25 B with a billion. Recent shares are going to be repurchased, which shows this is, major confidence in this business right now. In terms of the retail flow velocity, it's pretty high. A lot of retail investors are starting to look at this as well. I mean, institutional too. They're both looking at this, and they're both, wanting to get into this. For example, the smart money flow, like this has over 80% institutional investment right now. A lot of institutions are looking at Uber as the future. So the third pillar, let's get into it, is the sentiment mesh. Kind of going with what I was talking about. The retail sentiment is very bullish on it. The community sees the momentum and they know that it's going to pop. Well, it's already popping. So in terms of institutional sentiment, the institutions have been in this for a minute, since 2016, honestly. I feel like maybe even before that. We're not going to talk about private equity and all that stuff. But these major funds have increased their ownership by a lot. As you can see, they're over 80% plus institutional ownership. So in terms of a divergence, I'm not really seeing one, just because retail and institutional are both heavily, putting money into this company. So it's a good sign. Everything is aligned right now. Only red flags that I'm seeing is probably just the debt and the valuation. So the debt, kind of like I was talking about, was a big thing just because they were paying out so much money to their drivers, but now they are kind of eliminating that. So something to monitor. All right, now let's talk about the narrative arc forecast, which is our fourth pillar. Short term, strong company, very bullish, especially during the summertime. Uber Eats is growing like crazy. It has very strong guidance just because of AI and all the advancement that's going on. Now, medium term, of course, this company is going to be on fire. It's not going anywhere. It's built the brand, it's built the name, all of that stuff. And it even has international expansion. So it's a very good sign. Now, long term, 2 to 5 years out, this is for sure a growth compounder. Right now, it's literally sitting around the 90s. And in 2 to 5 years, who knows where it could be, This is a very big one, which is why it's good to get into this semi-early. Obviously, since it's around its all-time highs, you don't want to just jump in that thing. Just wait till a 20% pullback, 25%. I prefer a 25% pullback. But let's get into the fifth pillar, which is the defensive edge, right? So what is the moat for this company? From what I'm seeing, it's the brand, the network, and the data scale. Uber is everywhere, and they're expanding internationally. So it's going pretty good. The platform has a high ticker name. It's to the degree of Apple. Not a lot of people think of Lyft. They more think of Uber than anything. So they are starting to get global dominance. It's pretty big. Now, the Ghost Premium Zone was 90 to 95, but it easily broke through that. So it's doing pretty good. Now, this was, just a major magnet once the momentum continued. But as you can see, a lot of people, once it hit that point, started taking profit. A regret probability wise, I'd say this is around 12.2%. If you skip it, you're likely to regret it after the next two earnings. It's going crazy. It's doing pretty good so far. But in terms of the liquidity trap risk, I'd say this is around 10%, 10.7%. There's some risk, but this is a pretty strong company, pretty stable. If you look at their 5-year chart, you can see that they are pretty consistent, and that's a good way to see, is this a company that if I get in, will I lose my money in? So there is some risk involved, of course, but a lot of massive moves are happening, especially around earnings. Now, in terms of the behavioral confluence score, I'd say this is about 8.8. It's pretty strong. A lot of things are lining up very well for this company, so it's on the right trajectory. In terms of the chart levels for Pillar 6, the support zone is floating around 80 right now. This is a good point for you to really get into. If it drops down to 80 again, it's good for long-term hold, and it is also pretty good for your options. I'd say the resistance magnet is closer around 93 to 95. So after it broke through that 52-week high, it pulled back quite a bit. Nothing major, but still pulled back quite a bit. Its all-time high right now, let's see what it was. I know its most recent one was around 93.5. Let's see what its all-time high is actually in real time, because I definitely want to know this. All right, so it's looking like its all-time high was around 97.71. So that is a number to keep your eye on for right now. Now let's go on to the seventh pillar, which is the valuation pulse. So the forward PE for this company, profit over earnings, is 28.82. And this is a pretty reasonable number for growth for a technology company at this scale. It's doing pretty good. In terms of the PEG ratio, it's about 1.06, which is pretty well balanced for the growth rate. So the price that you're seeing right now, it's not super inflated. It's pretty good. It's a pretty good value to get in, but obviously wait till after the pullback. Its enterprise value is 177.2 billion. So the EVs aligns tightly. The enterprise value aligns pretty closely with the market cap. So it's pretty good. It's a pretty solid estimation that the company's value is exactly where it should be. Now, free cash flow versus debt. This is a number that should be fluctuating pretty soon, but the free cash flow is 6.9 billion and the debt is around 8.3 billion. Not the best in the world. It is sustainable, but we'll see what happens after their next earnings and they've reported everything, just so we can see. Now, let's get into the 8th pillar, which is the seasonal return matrix. So its highest average return month is November right now. And it looks like the returns on that month are 11.52%, which is nothing to sneeze at. That's pretty damn good. And then the second highest month for it is January at 8.83%, which is also pretty damn solid. And then a good point to actually get into the company at its lowest average return would be March, because that's about negative 4.2%. They usually have a nice little pullback, so that is good for you. In terms of pillar number 9, its top competitors, we have Lyft with the yearly gain of 17.77%, pretty good. And then our second competitor is Sprout Social, and they have a yearly loss of about 50%. So I'm not touching that company. It's crazy. And then our third competitor is JFrog, and that has a yearly gain of 8.87%. So it looks like Lyft is doing pretty good compared to the other competitors. And then let's get into the 10th pillar, the last pillar, the best pillar, the summary metrics table. So its year over year revenue growth is 17.96%, which is pretty damn good. This is a pretty good rate of return for 1 year, And then profit margins right now are at 22.41%, which is also very good. So a way to think of profit margins is for every for every $100 that you make in the company, how much do you keep? So for every $100 that they're making, they are keeping $22.41. I think that's right. Now, in terms of the operating margin, it's at 6.4%. This is not the best in the world, so I feel like there's definitely a lot of room to expand, but it's not terrible. Now, in terms of return on assets, this is pretty damn good. 25.5% is pretty solid. It's a good place to settle your money right now. And then let's talk about the short float, which is 0.49%. And this really just means, are people going to short this stock? Are they going to say that this company's going to drop significantly in the long term? And then with that, we also have the short ratio, which is sitting at 0.49, which means there's minimal shorting pressure on this company. A lot of people aren't seeing it in a bad light. They see it as this company is going to blow up. But if this video helped you, if you got some insight from how to look at companies, how to break down companies, and the example of Uber, hit the like button and hit the subscribe button. You feel me? It don't cost nothing to support. If you have any companies that you want to see broken down or you want to get into, definitely drop them in the comment section and we'll break them down. We'll get into them. We'll look at the companies that you want to see, and at some point we'll help you balance out your portfolio. But until next time, peace.